The stock market. It's a world of opportunity where fortunes can be made and dreams can be realized. The allure of quick riches draws in countless individuals. But beware, the stock market is not for the faint of heart. It's a thrilling ride with exhilarating highs and gut-wrenching lows. Just like a roller coaster, the stock market is full of twists and turns. Without proper knowledge, you could find yourself clinging on for dear life. Before you invest, understand the risks involved. Every investment carries inherent risks. The stock market is no exception. Prices can fluctuate wildly in the short term. Economic news and political events can send shockwaves through the market. Arm yourself with knowledge before diving into investing. Even seasoned investors make mistakes, but for beginners, these missteps can be especially costly. One of the biggest mistakes is chasing performance. It's tempting to jump on the bandwagon of a hot stock. However, what goes up must come down. Another common blunder is lack of diversification. Putting all your eggs in one basket exposes you to significant risk. If that one stock or sector takes a nosedive, your entire portfolio could suffer. Emotional trading is a recipe for disaster. Letting fear, greed, or panic dictate your investment decisions can lead to irrational choices. When the market takes a tumble, it's easy to get caught up in the frenzy and sell everything off in a panic. Trading commissions and fees can eat away at your returns. Choose investments that align with your budget and financial goals. Lastly, many investors fall into the trap of trying to time the market. They try to predict the perfect time to buy low and sell high. However, even the most experienced professionals struggle to time the market consistently. Navigating the stock market requires understanding its language. Two key approaches investors use are technical and fundamental analysis. Technical analysis focuses on charts and patterns to identify trends and predict future price movements. Traders use technical indicators like moving averages, relative strength index, and Bollinger Bands to gauge momentum, overbought or oversold conditions, and potential price breakouts. They look for patterns like head and shoulders, double tops, and flags to signal potential trend reversals. Fundamental analysis, on the other hand, delves into a company's financial health. Investors analyze financial statements, industry trends, management teams, and competitive landscapes to assess a company's intrinsic value. Key metrics like price-to-earnings ratio, price-to-book ratio, and debt-to-equity ratio help investors determine if a stock is overvalued, undervalued, or fairly priced. By comparing these metrics to industry averages and historical data, investors can make more informed decisions. Let's examine two prominent stocks from the Nifty 50 index: Tata Motors and Infosys. Tata Motors, a leading automobile manufacturer, has experienced significant volatility in recent years. Factors like global chip shortages, supply chain disruptions, and fluctuations in commodity prices have impacted its stock price. Infosys, a global IT giant, has shown more resilience. Its strong financial performance, consistent dividend payouts, and focus on digital transformation have made it a favorite among investors. However, even Infosys has faced headwinds from global economic slowdowns and geopolitical tensions. These examples highlight the importance of combining technical and fundamental analysis. Technical indicators could have helped investors identify potential entry and exit points based on price trends and momentum. Meanwhile, fundamental analysis would have provided insights into the company's financial health, growth prospects, and potential risks. Section 5. Building your investment arsenal. Strategies for success. Now that you understand the common pitfalls and analytical approaches, let's build your investment strategy. First and foremost, diversification is key. Don't put all your money in one stock or sector. Spread your investments across different asset classes, industries, and geographies. Staying informed is crucial. Keep abreast of market news, economic indicators, and company-specific developments. Read financial publications, follow reputable analysts, and attend webinars to enhance your knowledge. Set clear financial goals. What are you investing for? Retirement? A down payment on a house? Your child's education? Defining your goals will help you determine your investment timeline, risk tolerance, and asset allocation. Monitor your investments regularly. Review your portfolio's performance. Assess if your investments still align with your goals and make adjustments as needed. Don't be afraid to rebalance your portfolio or cut your losses if an investment isn't performing as expected. Section 6. The long game. Patience and discipline in the stock market. Remember, investing is a marathon, not a sprint. Patience and discipline are essential for long-term success. Don't get swayed by short-term market fluctuations or the fear of missing out, often referred to as FOMO. Stick to your investment plan, avoid impulsive decisions, and focus on the bigger picture. Time is your greatest ally when it comes to investing. The longer you stay invested, the more time your money has to grow and compound. Avoid timing the market. It's impossible to consistently predict market highs and lows. Instead, consider dollar-cost averaging, a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost basis over time. Remember, investing is a journey, not a destination. There will be ups and downs along the way. Section 7. Navigating market volatility. Staying calm amidst the storms. Market volatility is inevitable. There will be times when the market experiences significant swings, both upward and downward. It's during these turbulent times that it's crucial to stay calm and avoid making rash decisions. Remember, volatility is a natural part of the market cycle. Don't panic and sell everything when the market dips. Instead, view these downturns as potential buying opportunities. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Focus on your long-term goals and investment plan. If you've done your research and believe in the companies you've invested in, then short-term fluctuations shouldn't derail your strategy. In fact, market corrections can present opportunities to buy quality stocks at discounted prices. Section 8. The power of knowledge resources for the savvy investor. In the world of investing, knowledge is power. The more you learn, the better equipped you'll be to make informed decisions and navigate the complexities of the stock market. Fortunately, there are countless resources available to help you expand your investment knowledge. Financial websites like Investopedia, The Motley Fool, and Bloomberg offer a wealth of information on investing basics, market news, and company analysis. Reputable financial publications like the Wall Street Journal, Financial Times, and Forbes provide in-depth coverage of financial markets and investment strategies. Consider enrolling in online courses or attending investment workshops to deepen your understanding. Many reputable institutions offer courses on various aspects of investing, from fundamental analysis to technical trading. Section 9. Claim your surprise reward. Invest in your financial future. Congratulations! By reaching this point in the essay, you've already taken a significant step towards becoming a more informed and empowered investor. To further reward your commitment to financial literacy, we're offering a special surprise reward. To claim your reward, simply visit our website and sign up for our free newsletter. You'll receive exclusive investment tips, market insights, and access to our community of like-minded investors. Remember, the greatest investment you can make is in yourself. By continuously learning, seeking guidance, and staying disciplined, you can navigate the stock market with confidence and work towards achieving your financial dreams. Don't let the fear of making mistakes hold you back. Every investor starts somewhere. Section 10. Conclusion. Embracing the journey to financial success. Investing in the stock market is a journey filled with both opportunities and challenges. By understanding the common mistakes, embracing a long-term perspective, and continuously expanding your knowledge, you can navigate this exciting world with greater confidence. Remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to learn from your experiences. Embrace the journey, stay informed, and never stop seeking knowledge. Your future self will thank you for it.